Okay, we'll get cracking. As I say, thanks for everyone that's joined. I'm just looking down the attendees list now. So great to see partners from Dubai, partners from just looking here now, Houston, Miami. Hello, Nelly. So yeah, great to see everyone joining. We'll be around 45 minutes. Won't keep you too long. Purpose of the webinar really is just to give a deeper understanding as to what we do at API Global, how we do it. We'll then touch on some of our flagship developments in the UK, and I'll then pass you over to Lewis, who will touch on Bali and Thailand. Lewis, do you want to just introduce yourself?
Yeah, thanks, Johnny. Good evening, everyone, or good morning. If you're based in the US, like Nelly, my name's Lewis Finn. I'm the Global Sales Director for API Global. Many thanks for everyone who's joining in attendance today. Hopefully it'll be of interest. Obviously, there's a lot of, I suppose, global uncertainty at the moment in a variety of different things. And I think one thing that remains strong throughout uncertainty is real estate, and unlocking the right real estate opportunities typically over time proves very crucial. So that's something we're very proud to be disclosing and going through today.
Thanks, Lewis. I suppose just to follow on from that, just to introduce myself. I'm Johnny, Head of New Business here at API Global. So as Lewis said, just thanks again for everyone joining. So, okay, so what is API Global? What do we do? We've been around now for the best part of 15 years, really giving international investors access to property markets all around the world. In terms of where we've got offices based, myself and Lewis sit in our Dubai office. We've got head offices back in London and Manchester, and then a complete strategical global spread of offices ranging from Santiago in Chile right the way up to China, Hong Kong, and a big presence in Asia as well, in Singapore and Hong Kong. In terms of API Global, we sit as the mothership, if you like, with a number of subsidiaries or sister companies below us. We have API Capital Partners. They're responsible for dealing with our family offices and looking at bulk or block deals. We've got APIX, our athletes desk, which I'll touch on in a moment, but that's very much working with athletes currently performing at a high level and how we can help them generate long-term wealth for once they've finished their careers. We've also got Redstone, which is our lettings and management company. I'll again touch on them in just a moment. We've also got our mortgage broker, Valorem, and GoGo Prop, which is our bridging finance company. They help buyers who maybe certain demographics aren't able to obtain a normal regular mortgage. We can move them on to a bridging finance product, let them build up their credit score, and then move them to a more traditional based mortgage once they've got the score to do so. I'll tie in these companies in just a moment when I touch on our end-to-end service. Our ambassadors, some of you hopefully will be familiar with these names. Jack Catterall is a matchroom fighter. I think he's got a fight coming up in a couple of months. In terms of the golfers, we've got a couple of PGA Tour golfers that we sponsor and work closely with. Josh Berry, very much young and up and coming, and Thomas Dietrich, a bit more of a household name in the sport. And probably the most noticeable there is Bill Jackson, English cricketer, who we sponsor, actually on the back of his bat. He was in the Ashes a couple of months ago. I think he got player of the tournament, or he was certainly shortlisted to get that. So great to be associated with these sorts of characters. And I suppose it just embeds our credibility of the type of names that we work with.
You can, by the way, Johnny, you can never forget Steve Webster, who's famous for taming the tiger in match play about 20 years ago. So, yeah, we can't forget him.
Yeah, sorry, probably should have given him a shout out there. I don't think he's on, so he won't mind. In terms of our credibility, I suppose this is reinforced by some of our global partners, probably our most noticeable partners that we work with. So St. James's Place, one of the biggest financial advisory firms globally, 200 billion under management. We sit as their property division and advise their clients on real estate options throughout the world. Our owner, Michael Layton, actually sits on the board of directors in Asia for St. James's Place. So we have a great relationship with them. Allsop and Allsop, I'm sure anyone from the UAE or Dubai is certainly familiar with that name. arguably the biggest, if not one of the biggest property brokers in the Middle East. And again, we've been working with them for a number of years, looking at investment opportunities for their clients outside the UAE. Titan Wealth, a US private equity firm. Pam Golding on the bottom right, a big South African-based private real estate firm, and a number of other companies as well. I suppose it just solidifies the type of household names that we work with. And these are just a handful of our hundreds of partners that we work with all over the world. So I suppose the most important part for me is what do we do and how do we do it? We offer a complete end-to-end service. So a one-stop shop for international investors that want to invest in property globally. Now, I'm sure investors probably think, and I know they think, that investing outside their home country, it can be quite daunting. It can be quite cumbersome, quite difficult. We aim to completely take all that stress and strain away and act as a one-stop shop, making it a hassle-free investment for clients. We also want to make it the same as a client purchasing another asset, for example, a stock, a share, Bitcoin, whatever it may be, that once they press buy, they sit back and they watch their investment grow. That might be in the form of capital appreciation or rental income, but we very much want to make it seamless, simple, and hassle-free for clients that want to invest in real estate. Now, the first thing what we do is the market research and the due diligence, and that's what our dedicated sourcing team do. Make sure that any developments and projects that we bring to the table to offer our clients and partners, that the developer has a track record of delivering on time and delivering what they say they would. The financials of the development stack up. And often we've worked with these developers on a number of schemes before. And ultimately, that we believe that there's an investment case and an investment story where they're building the project. So we can give a return on investment for our clients. So that's the first part. The second thing we do is meet clients, meet buyers, and talk them through the financials of each project, find out what clients are looking for, whether it's something off plan, something that's completed, what the price point they're looking for, and almost reverse engineer it to present suitable options to them. And that's going through things like cash flows, presentations, making sure that the client understands the equity, the upside, the risk, what the potential returns look like, and making sure before they buy anything, they're completely aligned on what they're moving forward with. From that point, once the client has bought a unit, everything then is kept in-house. So we have a sales progression team that help act with solicitors for both the buyer and seller, move the purchase along to exchange in a nice, timely manner. We also then have our mortgage team, which is one of the subsidiaries that sit under API Global. That's Valorim Mortgage. They help clients all over the world obtain lending. And that's something that they've got great experience doing, with over now 100 lenders on their panel to make sure that we can get the best rates for clients and the best loan to values. I'll come back to that in just a moment when I touch on the UK as a whole. We also work closely with one of the UK's leading tax and accounting teams called Sapphire. They again provide advice around the best way for a client to purchase a property, whether that's setting up a simple limited company and being taxed from a company level, or simply buying in a personal name. The point is we have a team that dedicates themselves to that and make sure that clients are aware of the different options when purchasing a property globally. The final piece that we have is Redstone. Again, one of the other companies that falls under the API umbrella, and they're responsible for the day-to-day management of the property, finding a tenant, tenant sourcing, tenant vetting, making sure that the rent's paid on time. And if the client loses their keys in the middle of the night, for example, they're not calling the investment owner in America, Dubai, wherever he may be based. They phone the lettings and management company. Again, adding to that end-to-end hassle-free service. And ultimately, they make sure that that investment starts to generate a return for the client in the form of rental income. The last piece is the portfolio optimization. And I would say this is probably one of the things that stands out from competitors is once the unit's sold, we keep in quarterly contact with the buyer and let them know, firstly, how their assets performing, but what are their options moving forward. Now, real estate's typically a medium to long-term hold. So probably within the first 3 or 4 years, there's not going to be a huge amount of options. But once you start to approach that 5-year mark, that's when the client has a number of options that we make sure they're aware of and go through with them. Now, the first option might be sell the unit. We think it's kind of topped out on the growth. Exit and look to invest into something else. It might be keep the unit. We think it's got more growth left in it, and do nothing. Just sit tight and see how it plays out for the next couple of years. The third option, and what the most popular option for clients to do is, if we've helped a client buy a unit for, let's say, £300,000, and in 5 years' time that's worth £400,000, well, there's £100,000 worth of growth or equity in that property. We can help clients release that equity, which is classed as debt by the government, so it's tax-free, and we can then use that to buy an additional property only by ever recycling the equity out the first properties that have been bought. And that's ultimately how, over the last 15 years, we've been helping clients build multi-unit portfolios by just recycling the equity out the first couple of properties that they bought. Is there anything you would add to that, Lewis?
Yeah, I think just to add to that, I think a lot of nationalities, people in different locations often consider debt as a bad thing to have. Obviously, the mindset, I think, globally, is you sort of grow up, you buy a house, you pay off the debt as quick as possible. That's something that you're going to live in yourself. When you actually look at it from an investment perspective, debt is actually what I consider one of your best friends. And depending on the market you're looking at, if you're looking at the UK in particular, there's a very unique model, which is called an interest-only model, which is only used in 3 countries in the world. For me, that's one of the biggest USPs that the UK market has, because it allows you to borrow at typically a 70 to 75% loan to value, slightly higher in some locations, slightly lower in other locations, depending on client risk, affordability, but also the stress test of the rent. But you essentially never have to pay back that debt that you've borrowed until you sell the asset. Now, any debt that you borrow today naturally erodes over time in line with inflation. So if you borrow £150,000 today, in 10 years' time, that £150,000 that you borrow is naturally less for a monetary amount. So for me, I always look at it and go, why would you pay off more debt than you've actually borrowed? The beauty about an interest-only mortgage allows you to get 2 forms of wealth generation, not just your capital appreciation, but also your rental income, which over time actually outperforms the debt that you would actually pay down. So I understand that can be maybe slightly confusing for some people that have never heard of it before. And that's something that we can have a more serious conversation on and go into further detail outside of the call. But there are a number of different ways how we can make it extremely efficient by using the maximum leverage, certainly when you're looking at the markets such as the UK.
Thanks, Lewis. I'll just touch on our sales performance. I won't touch on this too much, but for me, I think it just maybe shows that we've certainly stood the test of time, been operating for 15 years, made it through COVID, still here to kind of sing the song, and I'm sure we'll make it through whatever's happening now as well. In terms of our track record, we've delivered now on over £2 billion worth of real estate globally, which equates to over 5,000 units. I suppose what makes me most proud and what I think is a sign and testament to a good business model is, of those 5,000 units, around 35% have been repeat buyers that have bought with us, had a great process, and come back to us to buy again. For me, that's I think when you're onto a bit of a winner. So I'll dive into the UK as a whole. As I mentioned at the start, we'll put a couple of case studies together, a couple on the UK, Bali and Thailand, which are more of our lifestyle investments, and Lewis can go through those. But just to highlight a couple of things about the UK as to why it's so popular with international investors all over the world. I think firstly, you need to look at the stability and the robustness. It's probably got the longest history of property data out of any country in the world. So the country itself has very much stood the test of time and made it through all incidents that have happened geopolitically economy-wise, it's also heavily regulated, which for buyers purchasing outside their home country, that gives them a lot of security and peace of mind when they're purchasing. For example, the solicitor that you deal with is regulated, the mortgage team regulated, the developer, the tax and accounting team, they all have certain policies that they have to adhere to and regulations, which for buyers means they're very well protected when they're purchasing. As you can probably see in the middle of the screen as well, there is a chronic housing shortfall in the UK. There's no better way to describe it than that. The population growth is quite simply outgrowing the number of houses that the government build each year. So that in itself creates a supply and demand imbalance. The government over the last 3 or 4 years have put targets in place to build 300,000 to 400,000 new homes each year. Last year they built 100,000. As long as I can remember, they've never got anywhere near building the homes that are needed to keep up with the population growth. The population is predicted to grow by 4 or 5 million in the next 10 years. And quite simply, the government cannot build enough houses to keep up with that. So that at high level creates a supply and demand imbalance in the UK as a whole.
I think just to add to that, Johnny, so when you're looking at housing targets and what's required to meet just the current demand, so we can go back as far as the 1970s, and as Johnny mentioned, as far as he can remember is only till the 1990s. If we go back another 20 years, we're talking when housing targets and sort of required numbers really come into play. And so when you're looking at deficits, there's been a need for 300,000 properties on a yearly basis for the last 50 odd years. The highest they ever got was about 240,000, which was mid to late 70s. And every year it's been a struggle to get to that number, surpass that number, or even get anywhere near that number. Like Johnny mentioned, in 2025 alone, there was 112,000 properties delivered nationwide, which, when you look at the law of economics, not just property, but any sort of asset class, whether that be the US market, the French market, the Turkish market, stock, shares, equities, whatever it may be, if you've got a greater demand, i.e. people needing to buy, or in property terms, needing to rent, than property that is available, you will naturally see an increase, one, in capital values, but also two, in the rental yield and income that is driven and achieved. And I think especially the UK, I think it's probably fair to say from a global perspective, is probably frowned upon as a place which may be probably an uncertain market. It's fair to say. Johnny and I are both from the UK, and I know certain people abroad who are UK nationals will think that, so let alone what non-UK nationals will think about the UK. But if you look back at any moment in time where there's been conflicts or global instability or political uncertainty, the UK has continued to thrive, and that's purely down to supply and demand. Like we can go back to as far as conflicts with the Gulf War. If we look at, more recently, like Ukraine and Russia and what happened there over the last sort of 4 or 5 years, like people aren't selling off their properties because there's a conflict, and you certainly can't sell off your bedroom, your living room, or your kitchen. So that creates a natural demand factor. And when you've got less properties coming to market because of planning permission reforms and conditions that are now being implemented because of changing political parties and government and what they require now from the outset, supply coming to market is more stagnant than ever, if not decreasing. But the demand, as Johnny's going to go into now, is consistently growing and will continually grow for a variety of different factors. So when you look at that pure imbalance of more people needing to buy, more people need to rent than properties coming to market or what are currently available, you will continually see an increase in price. And with that increase in price, you continually see an increase in rental demand as well.
Yeah, thanks, Lewis. I think just to follow on from that, hopefully we've highlighted there quite clearly that there's a supply and demand imbalance throughout the whole of the UK. We take it a step further and look at where specifically is seeing accelerated imbalances throughout the UK. So the likes of Birmingham, whereabouts in Birmingham, Manchester, certain pockets of London, why are certain areas seeing an accelerated population growth than other parts in the UK? And we can really underpin that by three main drivers that we look for. Firstly is corporate relocations and corporate behaviours. What are big companies doing in the UK? Where are they dispersing their staff to? You might have seen in the headlines over the last couple of years, or the last probably 5 years or so, certainly since COVID, there's been huge relocation outside of London for the likes of Goldman Sachs, Deutsche Bank, JP Morgan. All these companies had big offices in Canary Wharf, have now relocated to the business district in Birmingham to save costs, save overhead. So that's created an accelerated population growth in Birmingham, being very much financial driven in these relocations. Manchester has seen the same theme, but more on the media and the technology side. So the likes of Google, Boohoo, Amazon, again, have all relocated huge portions of staff from London up to Manchester. The second driver we look at is education cities. We look at cities that have got an educational presence that are home to thousands of graduates. Manchester and Birmingham are again prime examples of this. Both have 20,000 graduates graduating each year. Now, that's not dissimilar to a number of cities all around the world, but what does make those cities special is of the 20,000 graduates that finish their degree and graduate, over 50% of them are retained by the city to go on to work in professionals and go on to work for the likes of JP Morgan, Deutsche Bank, Goldman Sachs in Birmingham, and the media technology companies in Manchester.
I think just to add to that, I think anyone on this call can resonate with that, whether you are a parent, whether you are a sibling, whether you have friends, or you yourself have gone to university. People typically will stay, if you're looking at a major location, in that city post-education, naturally, because, again, regardless of where you are in the world, it's got good employment opportunities. Typically, that's why you've gone there from an education perspective. One, it's been your home for 3 to 4 years. There's a great nightlife, it's a great social scene. You've built up a friend base there. So when we look at the major locations, not just UK, but globally, where you can retain a percentage of graduates post-education, it's crucial, right? Because again, I think again, everyone can resonate with this. Students that go to university or college, regardless of where they are in the world, typically don't then have enough money to go and purchase a property or have a deposit for a property once they've graduated. If we look at global cities and sort of major hubs, students in college and university typically party for 3 or 4 years, I think it's fair to say. They get credit cards, they get student loans. So if we focus on locations where we're seeing a high retention rate of those graduates, that creates a huge demand in that local economy because naturally those individuals have to rent. And, you know, if we take Manchester as an example where Jonathan mentioned, if you're retaining 20,000 graduates on a yearly basis, well, you can't build 20,000 new properties every year. Certainly not in city centre and certainly not in the zone 2 or zone 3 areas. So if we've got more graduates staying there than properties coming available, then we add on the corporate behaviours where businesses are relocating and bringing staff to new locations. That alone creates a huge imbalance of people needing somewhere to live and properties available. Then when you sort of add on the additional infrastructure and investment, macroeconomics, i.e. transport links and so on and so forth, all of a sudden the investment case is very compelling because it's purely economics of a greater demand and supply, therefore a price increase and a rental growth.
I think just maybe what the one last point to mention, slightly different to what I've just spoke about. I know we've got a number of UAE agents or partners based locally here, but we touched on it earlier from the mortgage piece. The typical loan to value or payment plan terms in the UK is 25%. 75% can be mortgaged. That 25% that a client puts down is staggered over the build phase. If I look at other markets, Dubai, for example, Dubai's got a lot of similarities to the UK, but a lot of differences as well. But a typical payment plan in Dubai might be 50-50. So it means from an equity stance, the cash that a client needs to put down on a property is significantly lower in the UK than other markets like the UAE. So it means in terms of ROIs and return on investment from capital deployed, it makes a huge difference only having to put down 25% as opposed to 50, 60, 70%, which is what we see locally here in Dubai. I'll dive into one of our case studies now. This is in Derby. The developers Wavensmere Homes, we've worked with them on a number of projects previously. They've also delivered on a number of projects outside of us, deliver on time, the spec they said they were going to do. So very much a credible developer in that Midlands area. Derby's a tier 2 city. Some of you might not be familiar with it. I'll dive into that in a bit more, but it very much has the exact same fundamentals that apply to the tier 1 cities, which, because it's tier 1, results in a slightly more affordable price point for investors. You can see starting prices down the bottom, studios starting from £167,000 with a 20% down payment, the rest on completion, which is the end of 2028. So it means for £40,000 less, £35,000, clients can enter a tier 2 city that is fastly becoming a tier 1 city. You might not be familiar with Derby. I hope the UK people are, maybe some in America not so, but I'm sure you're familiar with the likes of Rolls-Royce, Bombardier, Toyota. These are all companies that have their head offices and their bases in Derby. Derby at a high level has the second highest income per person outside of London in the UK. It's home to over 250,000 people in the city centre, with a top 20 university with 35,000 students. It's also had a 60% rental increase in the last 5 years. And one of the reasons that's due to is 4 billion being invested by the government through regeneration and helping the city grow and expand through economic drivers. It's also now one of the strongest yields in the whole of the UK. Certainly out of all the developments we have to market at the moment, this is the one that, from a yield perspective, offers the most for buyers. It's known as the innovation capital, home to 300 aerospace companies, with Rolls-Royce being the biggest and the most prolific in Derby. I'm not sure if anyone keeps tabs on Rolls-Royce and what's been going on, but maybe a couple of years ago, they secured a £9 billion contract, which over the last 12 months has caused their share price to double. It's led to huge office expansion throughout Derby, which has been one of the main drivers for economic growth within Derby. It's also had continued government funding for local businesses and growths. And any football fans, Derby in the Championship, they're in the running for playoffs. So potentially they might get into the Premier League, which would never do anything wrong for a city as well.
I think just to sort of resonate that with sort of where we are in a global perspective now compared to where we were maybe 4 or 5 years ago. If you roll back, anyone who's in the UK or from the UK or familiar with the UK, COVID, COVID was non-existent in the UAE. I think we had a 6-week lockdown. Everyone was back to normal. You didn't see the news and you didn't see sort of any negative press. Whereas in the UK at the time, from people based there, found it quite difficult. But what you saw was certain companies have exponential growth, huge increase in salaries, huge recruitment drives, and fundamentally that had a massive knock-on effect with the share price. So companies such as Amazon and Google, as an example, who are headquartered in Manchester, the reason why they profited so well is because I think, like many people globally, when you were in a lockdown situation and you couldn't get out to the gym, let's say, I fell foul of this. I ordered a spin bike to my apartment. I used it twice, never used it again. It got binned off, but that's what people did. People ordered dumbbells, they ordered weights, they ordered gym equipment of different sorts. But people wanted to feel like they were being active, albeit they may not have been as active as they wanted to be, right? But my point being is they went onto Google to go onto Amazon to order what they needed to do. The share price went through the roof if you look at over that COVID period. What we're seeing now, maybe not to the same extent, but certainly very similar, is that the Ministry of Defence contract they've secured, which is a £9 billion contract sort of across submarines and different sort of defence mechanisms, is absolutely proven crucial given timing of where we are currently, particularly in the Middle East, but also maybe further afield with the US and certain parts of Europe and South America. what we perceive may happen, right? So everything, when there's a political instability or political uncertainty or a global uncertainty, ultimately plays into our hand when we look at a real estate option, purely from the illiquidity aspect. But also when we look at the fundamentals of what drives growth, they typically go hand in hand. So when we're focusing on macroeconomic drivers such as the employers like Rolls-Royce that Johnny mentioned, when we actually dig deep into it, that they provide really, really compelling information, but also an investment behind it.
In terms of where the development's based, it's prime city centre on the river. Typically speaking, anything that's been water facing, no matter where it has been based, geography wise, it's performed well. Now, I'm certainly not saying that this is the same view that you might get on the Palm, but the concept certainly remains the same. Derby is centrally located in the UK. It's an hour and a half away from 80% of the major cities. So it's an hour and a half train from the likes of London, Manchester, Liverpool, Leeds, 30 minutes into Birmingham. The location itself, location is key with all of our developments, right? And this is the exact same. Centrally located, so it's walkable to the business district, it's walkable to the shopping centre, 10-minute walk to the train station, and again, makes that tenant profile that we're looking to attract here walkable to where they're working, or at least a short drive to the companies that we mentioned, the likes of Toyota, Bombardier, Rolls-Royce, which have all got their headquarters situated around here. We recently launched the project here, so it's something that we've probably had for the 2 or 3 weeks. It's actually the same price point that we sold a Derby scheme for the 2 years, so it's offering excellent value for clients. We've currently got the early bird pricing, so it's a great opportunity to enter that price point where you'll see the capital appreciation of the unit throughout the build phase. The next few weeks, next couple of months, the developer's going to look to increase their prices in line with what's going on in the market. So for that cheaper price point, it's a great opportunity for clients, direct buyers to enter at that tier 2 city that has all the key fundamentals of a tier 1 city.
I think just to add to that, Johnny, sorry, when we talk about pricing, again, where API fit in, it's not just we take a project and we sort of sell it for our network. Like, we get involved in sort of the capital stack and the appraisal side. So we look at land acquisitions, we work with developers to source them sites to make sure that they value the land, what they're paying for is what it should be worth. We look at the total GDV, which is the gross development value of a site, to make sure that mechanically it works, the feasibility is there from the cost to build, but also the profitability in there so that everyone can benefit. Trying to find a site in this location at this price point, Johnny, if you just go back one slide, you can see sort of on the water where it is. For me, one of all is a huge credit to API for securing such a prime location, but also for the developer that we work with, Ravensmere, in that, as Johnny mentioned, we sold with this developer 2 years ago, or that's the last site we sold them 2 years ago, off plan. It completed early 2025, so about 13-14 months ago. We've been able to secure the same pricing then the same pricing now as when we sold then. And that's not by chance or by coincidence. That's not because the market's dropped. That's because we've got such a diverse network and because we've got such a good relationship with Ravensmere. And it takes a lot of back and forth with developers to ensure that we're getting the right pricing for the market. We could have easily went out with this pricing 10% higher than what it was and started with one beds over £200,000. But when you're looking at the velocity of sales and when you're looking at a true investment case, and when you actually can showcase to an investor the true growth over not just the build period, but the discount they're getting for buying off plan, that's where you get true value. And that's what we've done for the last 13 years is build true value and build lasting relationships whereby we can showcase to our investors that if you buy now at a certain price point, and we look at that portfolio optimization over that 5-10 year period, that you can build that one property very quickly into 4, 5, 6 properties over the same horizon using the same capital you've invested at the outset. And that's why Johnny, I think we looked at the stats the other day. It was 32 or 33% of our business business of 2024 were repeat buyers in 2025 because of the investments that we've put them into, the ability for us to almost regurgitate the same capital to reinvest, and ultimately build that high growth, high portfolio, but using the same money you'd use at your initial investment.
Yeah, thanks, Lewis. Right, I'll just quickly touch on Birmingham. I suppose this has probably been our most popular development over the last couple of months. Developer Investing PLC, again, another developer that we've worked with on previous schemes, a great track record of delivering previous schemes on time to the spec they said they would. And again, that's what the sourcing team makes sure that the due diligence is done when we start working with developers to make sure that the security is given to buyers when they invest with us. Price points, the 1-beds are sold out here. So we're looking at 2 beds only. 2 beds are starting from 334,000, and there's probably about 50 or so left in the whole development. 1 bed sold out very quick. There was less 1 beds than 2 beds. It's left with 2 beds left. Still very desirable, very good on the cash flows and the rental projections. And as you may see in the middle of the screen as well, free stamp duty. What does that mean? Free stamp duty means that the developer will pay stamp duty for buyers who purchase in the month of April. Stamp duty typically between 9-10% for international investors wanting to buy. It can be one of the biggest barriers to entry into the UK property market. It's dead money. You can't build it into the mortgage. Unfortunately, you just have to pay it to the government. There's no way around it. So for the developer to offer in to cover this, it makes a massive difference to the ROIs and the equity clients need to invest into this project. The question you're probably thinking is, why is a developer offering to pay that? What's wrong? I thought the same. The developer had 2 different phases. Phase 1, we sold out a couple of years ago. Phase 2, they were looking to retain as part of their buy-to-let portfolio. However, the last couple of months, they decided actually they were going to put their finances and buy another site for another development, and in turn wanted to sell the units that they were going to keep. That meant that these units were coming to market when this development was complete, which means that from a buyer's perspective, there isn't a staggered payment plan like you would see with something off plan. The equity needs to be put into the property within the first 3 or 4 months. So to sweeten the deal for buyers, they offered the free stamp duty incentive, which has gone down very well.
I think also, Johnny, just to add to that, stamp duty may be alien to some people that are on the call. So I know we've got a lot of our US investors or partners on the call at the minute, or partners across the world. Like, stamp duty isn't a tax that you pay everywhere. So as an example, guys, in the US, you'll be aware that while there's no purchasing costs or acquisition costs, you would pay an annual property tax, which can vary depending on state. Some of the guys we sat down with, or where we did an event with in Houston recently, they're up to sort of 4.5% on a yearly basis. When you've got other countries where you pay annual property tax, Europe can be very similar. I own property in Portugal. I have to pay an annual property tax on that, as well as stamp duty. As Spain is exactly the same, right? And the UAE, you pay sort of a one-off tax as well. So it may be quite alien to a lot of people, but stamp duty is a tax that you pay the government, the HMRC, for the acquisition. The fact that we've been able to negotiate with this developer, as Johnny mentioned, for a relief of stamp duty is, for me, I've been in property a long time, I've been in investments a long time. For the last 15 years, I've never seen anything like this. And we've got reasons as to why we've been able to get the developer to do it, as Johnny mentioned. And the way I always look at it, mathematically looking at purely from an ROI perspective, is that stamp duty that you may be paying towards, let's say you've got a 2-bedroom apartment at £330,000, let's say, the stamp duty would be roughly about £29,000-30,000. Well, I look at that dead money that Johnny sort of mentioned or sort of geared towards. that same money could be utilised as a deposit on another property and essentially double up buying another asset using the same capital you would have with any other property anywhere else, ultimately allowing you to increase your asset net worth using the same capital you already have. Diversifying one off plan, one complete. And when I say off plan, for anyone in Europe or in the US or anywhere else in the world, that's pre-construction. You can put down a smaller deposit now and lock in the price and allow the asset to build over the growth, by also locking in maybe a completed asset and getting an income-driven property straight away. So you've got the best of both worlds.
Just to touch on this project, it's developed, completed. So in terms of a risk perspective for clients, it's very much at the low end of the side. It's developed. The units that have been sold and completed on are tenanted. So from a risk perspective, as I say, you don't really get much lower risk than this. The development, all of our developments from the developer come with a 10-year new build warranty, come with white goods like fridge, freezer, and so forth. This development itself is high-end, and I would say Birmingham has a real lack of high-quality, high-end developments that you would see in the likes of London and Manchester. And what I mean by that, it has a gym, cinema room, private dining area, rooftop garden, concierge service, co-working spaces, which have become very popular since COVID. And Birmingham has a big lack of this high-quality development. Places that your employees from your likes of Goldman Sachs, Deutsche Bank, JP Morgan, all earning good salaries, are going to want somewhere nice to live. And this is the exact type of tenant that a development like this, located in the city centre, will attract.
I think just to add to that, Johnny, if you were to put this development in Manchester, you'd have another £100,000 on the asking price. If it was London, it'd probably have another £200,000 on the asking price. Purely because, as you mentioned, you don't. Birmingham predominantly is, or historically is, sort of periodic buildings, so what we call a PD development, permitted development, which is historically office conversions or mill conversions, as an example. So we've done developments in the past which have been textile mills, we've had police forensic labs, we've had, believe it or not, a gun making factory, which have all been converted into new developments, which naturally keep their character, and they're traditionally red brick buildings. Birmingham hasn't really seen the sort of sex appeal that I think Boulevard offers and Origin offers, which is the big, the sexy, the shiny, which is probably more of an international style development where you've got the luxury style amenities and facilities with it. But with that, we've been able to capture sort of market leading rents, and with that, you typically will then see market leading capital appreciation compared to other developments in and around the local area.
Just touching on and circling back to some of the companies that have relocated huge portions of staff to Birmingham, the likes of Goldman Sachs, JP Morgan, all now have huge offices in Birmingham. You've also got the likes of Jaguar Land Rover, a huge hospital home to thousands of NHS staff, which means that for Birmingham, it's got a diversification of industries, which makes it very appealing to investors. You're not reliant on one industry, where if that industry has issues, it can affect the property market. Birmingham has a diversification of a number of different industries. You've also got, in terms of transport links, the HS2, which is due to come in the next 2 or 3 years. That is a speed train line connecting Birmingham to London in 45 minutes. So it now makes Birmingham commutable to work, to live in Birmingham, commuting into London, a quicker commute than certain zone 3, zone 4 areas. And that are the drivers behind the population growth that we're seeing in Birmingham. A couple of other key points for Birmingham. We've got projections 2030 with the regeneration that's being pumped in by the government. House prices set to rise by 26% 2030. And again, with all of the developments, as I've mentioned, the location is of paramount importance. You can see Boulevard Origin here on the right-hand side of the screen. It's within the Ring Road in Birmingham, centrally located, 10-minute walk to the Jewellery Quarter, to the Mailbox, one of the biggest shopping centres in the UK, to the Business District, and again, 10 or 15-minute walk to 4 or 5 of the biggest universities throughout the UK. So from a location perspective, it really doesn't get much better than where this is based. Again, a fantastic opportunity with the stamp duty. That dead money that Lewis referred to, it makes a huge difference on the ROIs when clients do not have that initial capital that they have to outlay. Developers extended it till April. It's been our best selling development over the last couple of months since they launched this incentive. We've got no doubt that it's going to continue to sell well until it sells out probably the next month or so. Anything to add on Birmingham, Lewis, before I move forward?
No, I think one thing probably to note is that Birmingham in 2025 was our second most sold city from a number of unit perspective. If we look at sort of the top three, we've got Manchester, Birmingham, and London from a number of unit perspective. Really, the fundamentals that you mentioned, I think, are critical, Johnny, and that's what we try and replicate across other jurisdictions. Derby's very similar, maybe on a slightly lower scale, but that makes it a more accessible price point. You know, 2 beds are around £80,000 to £90,000 lower than what they are in Birmingham. But then when we look at obviously places like London and Manchester, that then obviously opens up to others as well.
All right, I'll move it forward. In the essence of saving time, we'll go straight into Bali. Lewis, I'll pass over to you to talk on this.
Excellent. Okay, so I think what's hopefully quite apparent based on the last 45 minutes or 47 minutes, where I appreciate it's probably slightly longer than what we wanted, Johnny, but we do like the sound of our own voice, is that we're not just a one-trick pony. We do have a diverse offering, not just UK focused, but now on a sort of a global perspective. For me, or for the business in particular, Bali is close to our heart, i.e. we develop ourselves. So we're not just an agency that takes on a development and then tries to sell it to anyone. We actually put our money where our mouth is, which we do in the UK, but Bali more so because we are the developer. And I think the reason why we looked at Bali is coming off the back of COVID. There is really 3 locations globally, 2 of which I'm going to touch on today. 3 locations globally which really stood out as a tourist hotspot or a hotspot where people are relocating to, not just from an individual basis, but with families for a magnitude of different reasons. One, the UAE, where Johnny and I live, and listen, it'll be my home for a very long time, and I absolutely owe an abundance of my life to the UAE, as does Johnny, and I think it will continue to go in strength regardless of what's going on. But 2 of the markets that we've really crunched down on, applying the same fundamentals and macroeconomics that we've looked at in the UK, are Bali and Thailand, of which I'm going to touch on both now. So Bali, when we look at, for us, Bali and Thailand, very much a lifestyle investment. So when we look at the UK, you know, it's the oldest market globally, the most mature market. You've got years and years worth of data which you can back up, and you can't necessarily predict how the market's going to perform or react, but you've got a good gauge as to what drives the economic growth and fundamentals as how you get from here to here, along with sort of Bank of England base rates and sort of the regulated mindset that the banks and the lawyers particularly have, right? With Bali and Thailand, you have what I'd call as an emerging market. Still in the UAE, really classed as an emerging market, which I disagree with. I think the UAE is far more than an emerging market now, given where it's come from. But I think the Bali and Thailand markets now, while still are emerging markets, are at the top tier emerging markets, because the fundamentals and sort of the macroeconomic drivers that are now being applied to these markets are completely different outlook and mindset from maybe where it was 10 years ago. What you've got to remember is these 2 markets are very tourist reliant, as was the UAE probably 15 years ago. So they need to do everything in their power to make sure that more people are coming on a yearly basis. So for us, Bali, we've got a number of different sites at the moment. We're just completing a site in Ubud. We've got 2 phases. Phase 1 is literally handing over now, which is fully sold out. Phase 2 hands over in 12 months, where we've got 3 villas left. And then we have got a site in Uluwatu, which is sort of south of the island, which you can see here on the screen. very close to the airport, where we have 5 villas left out of 10, which completes in Q1 2027. Now, as I mentioned, Bali and Thailand for me are very much lifestyle investments. So it is somewhere where you are emotionally attached to, because particularly Asia and the Middle East, but also more of an uptick now from Europe. We're seeing more and more, not just young professionals, but families that want to go there for 1, 2, 3 months a year at a time for a variety of different reasons. So they have their own home they're based out of that they can sort of keep in control and then benefit from that home that they own for the remainder of the year. Now, you've got a variety of different occupancy rates within these sort of international markets. Particular areas that we focus on, such as Uluwatu, where we're seeing up to an 80% occupancy. The numbers that we will typically forecast out from a financial cash flow perspective are on 70%. But really, when we're looking at the investment opportunity, we're trying to follow the same fundamentals of corporate behaviors, i.e. how we translate that to Bali and Thailand, but particularly now Bali is digital nomad visas. So not just entrepreneurs and sort of CEOs and directors, but anyone really, Silicon Valley from the US, a lot of their tech companies relocated to Bali and Thailand during the COVID period to be based in this remote working environment. If you're earning $50,000 a year, you can get that digital nomad visa and therefore be attributable to benefit from the island and sort of the economic growth. For me, out of the 2 developments that we've got, Senai Residences is my personal favourite, purely because I'm more of an Uluwatu style gentleman than I am more Ubud style gentleman. If anyone's been to Bali, Ubud is more sort of a you find yourself. It's probably the most subtle or political way to say it. Whereas Uluwatu is a bit more outgoing, which for me, it typically works better. But Uluwatu, Senai Residences, you've got 10 beautifully crafted villas. The price point, you can see on the screen, from 389,905. If you convert that to sterling, you're just less than £300,000. And the great thing about Bali is that as it's a lifestyle investment, but there's an emotional element to it, the income side of things are typically a lot higher than other markets that we'll look at. So, typically in the UK, we're targeting around a 6% average yield, whereas Bali, we're looking at anywhere from a 14 to 15% net yield after deductibles. That's including tax as well, which is all taken care of by the management company. And the great thing is that if I look at the last 5 years, the land value alone with the asset is appreciated at 10% compounded yearly basis. Now, when we look at our forecasts and our growth, looking into that lifestyle type of investment, we're putting considerably less into our numbers just to be on the conservative side. The difference between Bali and the UK is that Bali is cash only, so you can't leverage, whereas the UK model is very leverage focused. Because you can't leverage, that's where you see the higher yield return. So as I mentioned, 14, 15% net yield. So if we're looking at, if I base it on a sort of 70% occupancy rate, you should be generating anywhere from $55,000 to $65,000 on a yearly basis net income that could then be paid into any bank account in the world. It doesn't have to be into an account in Bali. It can pay into the US, into Turkey, the UAE, wherever you guys are based. That can be paid by the management company. And I suppose just to show proximity, so you can see here where my cursor is, that's where Senai Residences is. So you're right near the coastline. You've got 270-degree view of the sort of south coast at Uluwatu, depending on the villa that you've got, the 10 villas. It's not a huge community, so you typically have a view of most of the scenery. But to give you proximity to where you are, so like the Six Senses Resort, Nukuta Golf Course, White Rock Beach Club, Bingham Beach, you can see they're all within close proximity, which, as I mentioned, from a lifestyle perspective, somewhere where you want to go and base yourself for 1, 2, 3 months at a time. For me, this is the perfect investment. And I know we've got a lot of people on from the US or Europe at the moment, where you may go to South America or Portugal or Spain as an example, this could be a great alternative where you can actually get higher yields on a monthly and a yearly basis. And then Phuket, that's our second lifestyle option. I've actually just come back from Phuket. I've not probably been to Phuket for, I don't know, 7-8 years. And I've spent 10 nights there, and I was, what I can say, pleasantly surprised. The whole island's completely changed. The infrastructure, the investment that's been applied into sort of tourism, making the roads proper roads as opposed to dirt tracks. I remember Thailand and Phuket as you had bin bags in the roads, and there was a lot of weird smells that you particularly maybe not used to. But the whole place was plenty surprised. I was very, very excited to be there, and it's somewhere I can see myself going back on a yearly basis. And not just from a single man perspective, but I was with my wife, I was with my little daughter, and they had a phenomenal time. And what we're seeing now is a huge transfer of wealth from various different countries. Particularly, we've seen it in the Middle East over the last 4 weeks. A lot of wealth move out of the UAE to parts of Asia, Thailand being one of the main parts, Bali being the second other. Because of the lifestyle that you can live and enjoy now is second to none. And I think that the stats on the screen speak for themselves with the amount of new people that are moving there, the education that's now being implemented from an international perspective. You've got Australian, French, UK baccalaureate as an example. So it's not just focused on one particular demographic or nationality. It's very much open to the global population. There's huge tax benefits, again, with digital nomad visas, so on and so forth. For me, I'm very proud to represent one of the leading developers, not just in Thailand, but arguably across Asia, which is Lan Kwai Fung, LKF Holdings, which is owned by a gentleman called Dr. Alan Zeman, who's got a great story, and with more information we can share on him, who's built unbelievable and absolutely beautiful residences throughout Thailand and Phuket, and in particular the Bang Tao area of Phuket. This development hands over in Q3 2027, so we're looking at about 15-16 months. That's phase one. We've got another 280 units which will be launching probably in about 9 months, which is phase two. And the great thing about Thailand is you have not only leasehold but freehold options to purchase as well. The way that Lan Kwai Fung have structured the development, which again is very unique to the Thailand offering. And the yields again that we're looking to achieve or exceed are around 10% plus. Again, just to give an example of where it is in a location. Phuket Airport is here. You can see north of the island. Bang Tao, which is I consider 20-30 minutes away, which for me is the Mayfair of Phuket. It's the very prominent or well-to-do area. Further south is probably the Coventry of Phuket, where Jonathan's from. But yeah, listen, unbelievable island, unbelievable country. There's a lot going on, and the wealth transfer that we're seeing now, and we have done for the last 4 or 5 weeks, is being obscene, and the market continues to grow and grow and grow. And with that, we're seeing a huge rental demand and income growth as well.
Thanks for that, Lewis. I think 2 really good alternative lifestyle investments there for partners, clients to have a look at if they are looking for something slightly different to what the UK offers. That's all, guys, right? I know we've ran maybe 15 minutes over, but hopefully everyone took some value away from that. I've left a link down the bottom. If anyone wants to schedule a one-to-one meeting with me and Lewis tomorrow, Friday, or next week, just scan the code. You can book a time in that suits you and suits us. And we're happy to go through anything in more detail, whether it's with clients, partners. We're happy to help here. There's been a few people mentioning in the chat, will the deck be sent over? Yes, the recording will be shared for you to circulate with your network, clients, for your own use. And the deck as well, we'll share with everyone as well. So I'll keep this on screen. If anyone wants to book a follow-up meeting to go through their options, as I say, we're more than happy to do that. Thanks again for everyone's time. I'll leave US to enjoy the rest of their day. Dubai, enjoy your evening.